But you still are going to encounter these issues with the subprime marketplace. We're starting to see that with the Japanese yen crosses. The Great British Pound, Japanese yen has been very volatile. The Aussie, Japanese yen has been very volatile. And the New Zealand Japanese yen has been very volatile. In fact, of them, the New Zealand and Aussie are really at the top end of the range as far as declines over the last several weeks. So there's a lot of volatility going on there. And I think I'm segueing now into some of the market opportunities. I really think that the bulk of the market opportunity is going to stay in the Japanese yen pairs. Japanese yen has been at basically a zero interest rate forever because of the deflationary pressures that have been going on in Japan. They've kept their currency weak, I think, as part of their long-term strategy. In general, if your currency is weak, it tends to increase large exports and large commercial transactions. And because the interest rate discrepancy was so high, in fact, in some cases, I believe the New Zealand dollar and the Aussie dollar were the peak. I think the New Zealand was about 8% and the Aussie was 7% net spread, which means if you went and, let's say, borrowed money at 4%, and you went out and used that to sell pound or sell yen, which is going to cost you another, let's say, 1%. So your total cost is 5%. You can make 2 to 3% on your money. Say 3% and 2% on your money, literally risk-free, because of the way the interest spread was going. The reason why you're seeing so much volatility is because these trades now have to be unwound, where now they're going to be selling New Zealand dollars and Aussie dollars and then buying Japanese yen. In some cases, it's because their loans are being called. So one of the things, I don't know how it goes in other countries, but in the United States, when you have a mortgage, there's typically a clause in the mortgage which gives the bank the right to immediately call the loan, which means give me my money. So if the bank loans you $200,000 for a house, and you turn around and give that house to somebody else, the bank, according to the contract, has the full right to say, give me my money. I want you to give me my $200,000 that I put up so that you could move into this house. So with all these carry spreads, if somebody has financed the carry trade if they're leveraged in a big way, the bank or the broker or somebody can say, hey, give me my money. I want you borrowed $100 million from me. I want you to deliver the $100 million. And because of that, you'll see massive volatility. So let's take a look at what some of these currency pairs are looking like. Give me a moment to build the chart here. Don't know what is going on here. Bad tick. There we go. Okay, I had to delete a couple of days worth of data here, so let me try and refresh. Excellent. Okay, so here's the Aussie yen. Subprime mess started right about here. You can see massive slide, big time volatility. I was actually short the yen back in this area here as well. I am not short. I'm sorry, I was short the Aussie yen. I'm no longer short this currency pair. And then we had a really good rally. You can see here that the market failed to penetrate through the prior resistance and has since dropped off again. And then it was pretty much over.